What if I told you that Canada's entire mortgage system is backed by about $14 billion in reserves, yet that same system supports hundreds of billions of dollars in mortgages across the country? Today, we're going to break down how that works, what the Canada Mortgage and Housing Corporation actually does, and why it matters to every Canadian homeowner, renter, and taxpayer. Because when you understand how this system works, you start to see Canada's housing market very differently. CMHC was created in 1946 after World War II to help Canada build homes and support returning veterans. Over time, its role expanded dramatically. Today, CMHC does three major things. First, it provides mortgage insurance for home buyers who put down less than 20%. Second, it guarantees mortgage-backed securities, which allow banks to sell bundles of mortgages to investors. And third, it administers various federal housing programs. But the real financial power of CMHC comes from the first two roles: insurance and mortgage funding. According to CMHC's most recent financial statements, the organization has roughly $13 to $14 billion in capital reserves. That capital is meant to cover losses if borrowers default on their mortgages. Think of it as an insurance buffer. If someone stops paying their mortgage and the lender suffers a loss, CMHC steps in and covers that loss, assuming the mortgage was insured. But here's where things get interesting. While CMHC holds about $14 billion in reserves, it backs a much larger mortgage system. Estimates show CMHC supports over $400 billion in insured mortgages across Canada, and that doesn't even include all the mortgage-backed securities it guarantees through programs like National Housing Act Mortgage, Backed Securities Canada, Mortgage, Bonds. These programs allow banks to bundle mortgages together and sell them to investors. Those investors provide cash back to the banks, which then issue more mortgages. That's how liquidity flows through the housing market. So here's the key question. How does $14 billion support a mortgage system worth hundreds of billions? The answer is leverage. In simple terms, each dollar of CMHC capital supports dozens of dollars in mortgage exposure. This is similar to how banks and insurance companies operate. But it also means that the housing finance system relies heavily on confidence and stability. As long as defaults remain relatively low, the system works smoothly. But if large numbers of homeowners suddenly default, the system faces substantial pressure. There is one critical piece that makes the system work. CMHC is a crown corporation owned by the federal government. That means CMHC's mortgage insurance carries the full backing of the government of Canada, the taxpayer. If losses ever exceeded CMHC's internal reserves, the federal government would ultimately step in. And because investors know this, Canadian mortgage-backed securities are considered extremely safe. This government guarantee helps keep mortgage rates lower and ensures banks can continue lending. Canada's mortgage structure was designed with several goals in mind: to make home ownership more accessible, to ensure banks can continue lending even during economic downturns, and to keep mortgage markets stable. Mortgage insurance reduces risk for lenders. Banks have figured out how to maximize profits while passing the losses on to taxpayers. And this is how they do it. Securitization provides liquidity to financial markets. Together, these programs keep the housing finance system moving. But systems like this also carry risk. If housing prices fall sharply, if unemployment rises, or if mortgage payments become too expensive for homeowners, defaults can increase. And when defaults rise, CMHC begins paying insurance claims to lenders. That's exactly what the capital reserves are meant to cover. But because the mortgage system is so large, the federal government guarantee is the ultimate safety net. Many Canadians debate housing affordability, interest rates, and real estate prices. But behind all of that sits a financial structure that supports the entire system. Roughly $14 billion in capital, helping support hundreds of billions in mortgages. Understanding CMHC helps explain why government policy has such a powerful influence on housing in Canada. Because housing isn't just a market, it's a system built on insurance, guarantees, and financial confidence. And that's something every Canadian should understand. Because housing policy doesn't just affect homeowners. It affects taxpayers, banks, and the entire economy. If you found this breakdown helpful, make sure to subscribe.